This week's number, $500. That's how much the South Korean government is paying reclusive kids per month to go outside. I spent my entire childhood inside. As a matter of fact, I used to walk in on my parents having sex all the time. Worst 45 minutes of my life. Welcome to Prof G Markets. Today, we're discussing Apple's high-yield savings account. That's right. That was a good segue. And a roundup of the latest developments in AI. Here with the news is Prof G media analyst Ed Elson. Ed, how are you?
I'm terrible, Scott. I've had the worst 2 weeks of my life without you.
Really? Oh, that's right.
Yeah.
You guys, well, we
felt
didn't.
like a lifetime.
Yeah, we didn't do, and we don't have substitutes, right? We don't bring in someone else or something, do we? That's right. We just stack a bunch of stale, perishable or non-perishable news shit. So what have you been doing the last 2 weeks? Did you go on vacation? What did you do?
I was still working on No Mercy, fact-checking your book, which, by the way, I think is going to be your best book ever, not to give too much away.
That's right. Number 5 is always, you usually get it right by the 5th book. Yeah. And what is it you like so much about my book, Ed?
Can we talk about it? I don't know if we've gotten the go ahead to talk about.
So I don't know if you've heard, but I own this taco stand. We can talk about whatever the fuck I want or we want.
Well, it's called The Algebra of Wealth, and it's basically takes a lot of the insights that we've developed on this podcast and puts them in writing with extremely actionable advice for young people and honestly up to any age about how to get rich and how to build financial security. And I just was going through and fact checking stuff, and there weren't too many errors, but it was incredibly informative. And I can't wait for this book to release.
Yeah, well, thanks for saying that. We tried to do something. I wanted to do something that I wish I have figured it out, but it took me a long time. And I thought to myself, how could I have figured it out sooner? And that's what we're trying to do here. But anyways, enough about how awesome we are. Talk to us about the news.
Let's start with our weekly review of market vitals. The S&P 500 was stable as earnings rolled in. The dollar was also stable. Bitcoin hit a high for the year above $30,000 before plunging again, and the yield on 10-year treasuries tumbled after 4 straight days of gains. Shifting to the headlines. UK inflation hit 10.1% year over year in March. That's down slightly from 10.4% a month earlier, but still a disappointment. UK inflation hasn't dropped below double digits since last summer. China's economy expanded 4.5% in the first quarter of the year. That's a strong rebound from 2022. Throughout last year, GDP growth was roughly 3% as the country dealt with its zero COVID policy. Meanwhile, India is set to surpass China as the world's most populous nation by 2023. Side note, Apple also just opened its first flagship store in India, which has the second largest smartphone market in the world. Tesla reported earnings, and it was a miss. First quarter profits declined 24% year over year. That's largely due to the company's recent price cuts. Its most popular car model is now 30% cheaper than it was at the beginning of the year, and Tesla shares fell more than 8% after its report. And finally, Netflix missed expectations on revenue but beat on earnings per share. It also announced it will delay its crackdown on password sharing until the second quarter. The company anticipates that will boost subscriptions and revenue when viewers are booted off of shared accounts and forced to pay up. Your thoughts, Scott?
So the Netflix one is interesting. You would think, why wouldn't they crack down on passport sharing just as a general practice? And I guess a certain amount of breakage or leakage or sharing is a good way to get people hooked on content and then move in and say, all right, now it's time to pay. So let them steal it, give it to, it's almost like a free trial. If you let people borrow their passwords and then they get hooked on a certain program or that type of programming. And then I guess they've done the math and said that the additional people exposed to Netflix, it's worth it because the additional paying customers they'll get when they clamp down pays for the lost revenue. Tesla, it's just super interesting. That's dramatic. Think about that. A car that is 30% less than it was
Hmm.
at the beginning of the year. So is that this year? It's in just
Yeah,
4 months, it's declined a third in value.
yeah,
I mean, can you imagine if you bought the car in November of last year and now it's
yeah.
30% cheaper?
And
That's
now it's eligible for tax credits as well.
Yeah, and then the big one, I think population is going to be a big issue. I'm fascinated by demographics. India being the most populous nation in the world is really fascinating. About 30 years ago, if you had asked a bunch of analysts who was going to be the economic superpower of the 21st century, it would have been split. Some would have bet on China, some would have bet on India. And China, obviously, incredible manufacturing prowess, huge consumer economy. There are some real efficiencies to an autocracy. You can kind of just get shit done really quickly. But India was a democracy, largest democracy in the world, more English speakers. So we thought, being kind of biased towards our system, a lot of people thought India was going to be the economic juggernaut to watch out for. And boy, did we get it wrong. China has blown by India. A lot of it is population, though. When you have a huge middle class and you have innovation and an economy that's growing, you end up with a ton of consumption and an economy that just booms. What they also have is there's something called I think it's called a dependency index, and that is what percentage of the population is being supported by people who are still working. And I believe that India has the advantage there that China, because of its one child policy, is going to end up with a large dependence ratio at some point. So I think a lot of smart people who are informed by really intelligent economists, i.e., Apple, have decided they need to start investing in India. China's GDP numbers, I never know if they're right or wrong. The numbers that come out of China, I just never know what they're worth. I
Yeah.
guess you got to take them at face value. And the number that I find really shocking is the UK's inflation is at 10%. It's by far the highest in all of Europe. And you really see it in food prices here. I think food's up 16 or 17%. And there are just few nations that could have fucked themselves more, other than maybe Russia's invasion of Ukraine, than what Britain did with Brexit. It just, they basically made all their goods more expensive and at the same time reduced exports, bringing down salaries or bringing down economic growth. So I believe they're the only nation in Europe that hasn't grown the last 5 years. So the standard of living for all citizens or the majority of citizens in the United Kingdom has declined. And at the end of the day, the government is supposed to prevent these boneheaded decisions. This was just a disaster. David Cameron, absolutely strategic blunder, thinking that this would be rejected. It wasn't. It passed. Few people have done more damage to the UK than Nigel Farage, and I wonder how they get out of this. I wonder if it's a slow burn back, or I mean, I'm just fascinated by this. What is probably the biggest self-inflicted wound of the last 50 years in the West, and that is, well, there's probably more. I don't know, maybe Iraq, but Brexit really will go down in history as just, I don't know, how to snatch defeat from the jaws of victory. Do you have any thoughts, Ed?
Well, I was just going to ask you if people are talking about prices in the UK. I mean, I haven't been back in like a year. But do people talk about this? Is it part of the daily conversation?
Not amongst my friends. I don't have that many friends here, and B, the friends I have are wealthy, which
Yep.
sounds like sounds like a douchebaggery thing to say, but they're just not. Where I've seen it or where I've noticed it is food prices, and now
Yep.
I'm not talking about restaurants. The housing here is crazy expensive, but London is kind of an anomaly. London is sort of a sample set of one because there's just so much money here.
Hmm.
So I don't feel I haven't lived here long enough to really notice what I'll call, a step change in prices. I have noticed one, I think the actual grocery food here is better. I love the packaging. It's healthier, more organic. It really
Hmm.
struck me one of the observations I would have about living here is that if you can afford it, if you can afford to buy quality, high-end, healthy grocery, the industrial food complex here is much healthier. That our food system, our food supply chain in the United States is just less healthy.
Yep.
There isn't nearly as much fresh food. The fresh vegetables are better here. You can tell they just rot faster, but they try to get you stuff farm to table faster. The packaging is more elegant. I think it's just a healthier, I don't know if it's regulation,
Yeah.
but I get the sense you are healthier, that the middle class here has access to healthier food.
Yeah. I think there's been a huge emphasis on food safety regulation in the UK. And then they have the Fair Trade Association, which basically vets how organically and sustainably foods are being processed and that those labels are put on the packages in the UK. It's definitely got a stronger regulatory environment. But I just want to shift back to Tesla for a second. So something I was seeing on Twitter today, Tesla used to boast that it had basically the highest margins of any other what's called an OEM, which is an original equipment manufacturer, i.e., you're a car company and you're making your own cars. That used to be their big point of differentiation. That's no longer the case with these price cuts. So just some numbers here. Tesla's gross margins now are 19%. And you compare that to Stellantis, which is 19.6, Volkswagen 20.1, Mercedes-Benz was 22.1, and the European average is 20%. And then obviously luxury, which is a whole different ballgame, that's 31%. So it feels like this is a big hit to Tesla. Do you look at the margins situation and look at the price cuts as a big problem for the business going forward?
Margin is a great litmus test of your differentiation. So brand is synonymous with differentiation, and then kind of the ultimate litmus test of differentiation is your margins. And there's really kind of two ways to build a business or add stakeholder value. One is to pursue a differentiation strategy, and LVMH, Dior, or a Celine bag is highly differentiated in the eyes of the end consumer. Walmart's products are not differentiated. They sell ginger ale and Tide. That's an operations play where they try to be as efficient as possible, and their differentiation is operations and getting you, more for less, if you will. So margins are a pretty insightful tell around differentiation. And what do you have here in the EV market? You have an incredible decline and implosion in differentiation brought by competition. And that is, a Tesla was wildly differentiated, as in singular, just 2 or 3 years ago. You wanted to buy an EV coupe that could go 0 to 60 in 3 seconds and had a range of 300 plus miles. It was not only differentiated, it was unique. It was the only one. And for a long time, its differentiation was reflected through incredible margins. Now, what's happened? Everyone's piled in. Everyone's trying to grab share. So it's very competitive from a pricing standpoint, and they've been forced to lower their prices, which impacts their margins. Also, they've had some exogenous reasons to lower their prices, and that is to qualify for the tax credits. But this is mostly the field just getting much more crowded and pricing pressure that results in a hit to margins. They also probably are decided to stay ahead of the curve because they want to get to a certain scale. Manufacturing in the auto business is a business of scale because once you make those multi-billion-dollar investments in a factory, you want to punch out a lot of cars. So my guess is they've done the math and said it's better to go for share. It's better to maintain share leadership, get to scale. But this is there's just no getting around it. This is a huge hit to margins. All of a sudden, their margins are no longer singular. On announcement of that news, the stock market threw up on it. The stock was down about 8% in after hours when they first announced their margin hit. I think we're going to see the stock come down dramatically. I think the company is going to begin to look like a traditional automobile firm, and that is a lower margin, difficult manufacturing-based business. And all the analysts who tried to pretend it was a software company to justify these ridiculous multiples on EBITDA are going to realize it's a company that wraps steel around 4 tires and a motor, and it's a great company. But already its margins have gone from singular to kind of industry standard.
One final thought that I had is it was strange hearing Elon speak as the CEO on that earnings call because I feel like I've just gotten so much more used to him as this Twitter guy, as this SpaceX guy, and then seeing him. Meanwhile, he's the CEO of what's becoming a pretty standard car company. One, do you think that's a problem? I assume the answer is a resounding yes. But 2, do you see a future where Elon is no longer Tesla CEO?
I think effectively he's not the CEO. I can't imagine that. I think there's someone else just through kind of the space-time continuum where there's only 24 hours in a day. I would imagine there really is somebody else. I forgot her name.
Gwynne Shotwell.
Gwynne Shotwell, thank you. Effectively, they're the CEO. He's just a megalomaniac that wants the title and wants it's effectively the fastest way to get fired, I imagine, at Tesla or SpaceX is to actually grab a mic yourself or pose for a picture yourself or respond to press. I'm sure one of the first things in any sort of employee handbook is no one is allowed to get any credit or speak to the media but Elon Musk. I mean, we had trouble naming, these are important companies, and we had trouble naming who's effectively running these companies because I'm sure everyone's told this is the fucking Elon show. And I would
Yeah.
imagine the fastest way to get fired is to attempt to take any credit or steal some of his sunlight. So I don't imagine he's going to give up those titles unless it gets
Well,
really
to be
ugly.
clear, he's CEO of Tesla still, not CEO of SpaceX, but he is CEO of Twitter. So he's running two companies, and he's got someone else running Neuralink, but for sure CEO of two separate companies right now.
Yeah, it's just I can't imagine. I don't know. This he's speaking of singular, he's a singular business figure, and
Mhm.
so far it's worked for him and his shareholders. So maybe they know something we don't. But general corporate governance is you want a CEO who's very focused and accountable for one brand. I don't know if he's ever going to give it up. I, I can't predict it. What is inside those 2 years. I just have absolutely. I cannot relate to. I just know the only thing I'm confident of is he will continue to make childish, stupid statements.
Okay, let's move on to our next story. Apple has teamed up with Goldman Sachs to launch high yield savings accounts for Apple Card users. The savings accounts will offer 4.15% in annual yield, which is more than 10 times the national average. It's also higher than what's offered by many big name competitors, including American Express, Barclays, and even Goldman Sachs' consumer unit, Marcus. The account has no fees, no minimum deposit, and can be set up from within the wallet app. So, Scott, Apple says Goldman is operating these savings accounts. I take that to mean Goldman is doing the banking and Apple is just leveraging its technology. But Apple also has one of the biggest balance sheets in the world. It's got $129 billion in assets, $21 billion of that is cash. Do you think the goal here for Apple is to eventually become its own independent bank?
I don't know. I don't know if they need to. I think they want to focus on what they're good at, but effectively by becoming a bank or effectively becoming a bank, they're now the largest market cap bank in the world. And what I was thinking about here was we talk a lot about the absence of friction in tech being a danger. That a 21-year-old man with poor judgment can go from zero to disaster because he can put confidential national security information or sensitive national security information on a server.
Mhm.
That an individual, a 14-year-old girl, can go into her room and in almost no time get tons of content downloaded to her around suicidal ideation. That a run on the bank can happen in an hour.
Mhm.
Emails go out to everyone's phone. Everyone reads their phone in a meeting, and it says withdraw your funds from SVB, and they have an app, and they can initiate a wire and withdraw all of their funds in 5 or 10 minutes flat. There's just an absence of friction, and that has a lot of externalities, a lot of bad things. To me, this brings home the power and the potential of Apple because of a lack of friction, and that is I use
Mhm.
Apple Pay and then maybe it pops up when I pay for something saying, do you want to round up this purchase and put it into a savings account, which yields on average 5 or 10 times what a traditional savings account does? And I say yes. And then it says another prompt, would you like us to do this for every purchase? And do you want us to round up purchases under $10 to the nearest dollar, purchases over $100 up to the nearest $10? And then it says we estimate that you will do $700 or $800 a year, and then in 10 years, if you do this for 10 years at 4.2%, you're going to have $25,000. It just they can so easily get money and assets and
Mhm.
start providing financial services. And the analog or the kind of digital old school analog was you walk by a bank and it says 3 month CD, 3.4%. And you're like, wow, that's a great rate. I'll come back tomorrow. What is the
Mhm.
likelihood you'll find something better to do than going to the bank during business hours, wait in line, find out about this, fill out paperwork, transfer funds, fill out more paperwork? Well, guess what? All you need is an iPhone
Mhm.
and you can make those sorts of transfers and open up and start transferring funds. So I think this is a big win. And I would bet that this is going to be as big a win as Apple's goggles or headset or glasses is going to be a failure. It's the boring shit that moves the needle from a shareholder perspective, Ed. I think this is a great idea. What do you think?
Well, I was just going to say, speaking of the dangers of friction, Apple also officially launched Apple Pay Later a few weeks ago, which is basically you split up your Apple Pay purchases over time. It's another word for a loan. And then we were also looking at this stat the other day, which is that 1 in 5 buy now, pay later users are using buy now, pay later to pay for their groceries. So it feels like this is probably a slightly irresponsible move on Apple's part to push for consumer loans that can be so easily initiated by just double clicking on your home button on your iPhone, scanning your face, and then taking out a loan. Like if Afterpay made buy now pay later frictionless and easy, I mean, think what Apple Pay is going to do.
Yeah, I hate this. I hate buy now, pay later. I think it's total bullshit. I think it's preying on young people with and putting lipstick on a pig, saying, "Oh, this is innovation." No, it's not. It's debt. And generally speaking, we write about this in the book. There's good debt. There are times when it makes sense to take out a loan when you're trying to improve yourself and you need some money to get through college. I took out loans. I took out student loans in undergrad and graduate school, and it was worth it. Taking out debt on an asset that is increasing in value. And you got to be careful. You got to do your homework. But buying a home, you can get 5-to-1 leverage. You pay down that debt as the asset goes up, and the difference between the debt you owe and the appreciation in value is equity, and ends up being, for a lot of people, their primary means of building wealth. You're a private equity firm. You buy a business. The business increases in value at a greater rate than the interest costs. You pay down the debt with the cash flow. And again, you end up with a nice margin or delta between the debt you owe in 5 or 10 years and what the business is worth. So the flip side of that is using debt for consumption, using
Yep.
debt to buy things you really shouldn't be buying, using debt to buy a new outfit, a credit card or buy now, pay later for an outfit to go to Coachella. That is the wrong type of debt.
Mhm.
That limits your options, that keeps you poor, and that decreases the amount of money you can save and then invest and then put your investment dollars, your capital to work for you while you're sleeping and develop economic security as you get older. So this is yet another vehicle, mendacious fuckery of a consumer offering to convince people to spend more money than they have and
Mhm.
to live for the now as opposed to delayed gratification. I thought it was very sad to hear that there's buy now, pay later for groceries, because
Yeah.
that to me says that there are a lot of people that can't afford to eat. That was just discouraging, right? That
Yeah.
some people don't have the money; they have to go into debt to buy groceries.
Yeah.
But in general, I think buy now, pay later is not only a bad idea, not only bad for young people, bad for the country, bad for the planet. I think it's bad for Apple. I don't think
Yeah.
Apple should be in that business. And I understand it's not much different than a credit card, but it feels especially predatory.
Mhm. Yeah. It feels dangerous in terms of Apple's ability to maintain trust with its users, which is probably the greatest asset that it has. And it's what is allowing Apple to be a bank in the first place. Um, but I want to go back to that 4.15% rate. So, as Apple said, that's 10 times higher than the national average, which is 0.37%. That's the rate, that's the annual percentage yield that you get on an average US savings account. And to me, that is crazy because in the past year, Jerome Powell has raised the Fed funds rate, that's the risk-free rate, from 0.2% to 4.6%. That's in 12 months. And meanwhile, the average interest rate on a savings account has barely moved. So I did some research on this, and apparently this is always what happens. So if you look at this chart that I have in the doc there, and we can probably pull this up on YouTube, every time that interest rates rise or the Fed funds rate rises, the rise in the deposit rate barely moves with it. And then as soon as it declines, it sinks like a rock. And it turns out that there's a term for this idea of the percentage of federal rate rises that pass through to savings account interest rate rises. And it's called deposit beta. And right now, deposit betas are at historic lows. It's around 20%. In other words, every percentage point that Jerome Powell raises rates, you'll only have a 0.2% rise in interest rates, in savings account interest rates. So my question to you, Scott, is this seems unfair for depositors, for just regular consumers with savings accounts. Why is that happening?
So George Carlin said something really that really struck me as insightful. He said that just because companies and institutions aren't directly coordinating doesn't mean there isn't a conspiracy.
You don't need a formal conspiracy when interests converge. These people went to the same universities and fraternities. They're on the same boards of directors. They're in the same country clubs. They have like interests. They don't need to call a meeting. They know what's good for them, and they're getting it. And there used to be 7 oil companies. There are now 3. It will soon be 2. The things that matter in this country have been reduced in choice. There are 2 political parties. There are a handful of insurance companies. There are about 6 or 7 information things. But if you want a bagel, there are 23 flavors because you have the illusion. You have the illusion of choice. Right. You don't get the real important choice. There's no freedom of choice.
I think that banks wink and nod at each other and never put it down in email. But when interest rates go up, it's very sticky and very slow to pass on that incremental increase in interest rates to their depositors. Mm-hmm. And yet when interest rates come down, it's immediate. Sorry, we're cutting the interest rate we're giving you. The same is true of gas prices. Oil prices skyrocket, boom. You see it, the price of the pump immediately in a step change increase. Oil prices come down and they gradually come down, they lag. Mm-hmm. And there's an asymmetry of information in that as most consumers are really busy, especially retail bankers or retail banking clients, and they aren't following the Fed. And they're used to getting 0.4% on their money. They're busy. Maybe they don't really understand basic finance. One of the big deltas in America, or the big deltas in people's knowledge base, is there's a lot of incredibly well-educated people that understand how to do derivatives, understand how to do calculus, but don't understand the interest rates on their deposits and what it means, and that they need to track this stuff. Because the difference, 4% doesn't sound like a lot of money, but 4%, versus 1% on $100,000, over 4 or 5 years, that pays for a month of rent for your daughter at college. It just, and it compounds. So you want to be very sensitive and constantly, even putting out alerts, looking at interest rate increases. People don't think about the interest rates they pay on their credit card because it doesn't seem like a lot when it's only, if it's 18% a year, well, that's only 1.5% a month. Well, guess what? That year flies by, and instead of paying $400, you're paying $472, and you keep rolling it, and before you know it, you owe double what you used to owe just 4 years later. So there is a conspiracy to make it really slow on movements and things you have to pay consumers or prices you pass through when it's a benefit to the corporation. And there's a direct correlation when it moves away from the consumer. And what it all comes down to is consumers need to be thoughtful and on their toes and really need to understand this stuff and be on top of it and not afraid to switch banks. What Apple's doing here is clear. They have decided that in their next earnings call, they want to say, we launched this and we have $7 jillion in deposits almost overnight. The lack or the cocktail, the nitro and the glycerin of that frictionless ability to make deposits vis-a-vis the interface with the billion wealthiest people in the world, and the fact that they can afford to offer an above market interest rate, they are going to grab deposits like crazy. When they announce that in just a few weeks or a few months, they are now one of the biggest banks by deposits in the world, oh my gosh, the greed glands are going to get going for analysts and go, oh my God, Apple could become one of the biggest banks in the world or the biggest financial services companies in the world just overnight. So they've made a rational decision here to make a huge investment, offer a really big interest rate in exchange for establishing just a huge share from day one.
Yeah, I think another second order effect you'll see is that as everyone learns about this APY rate that they're offering, the competition for higher yields is just going to increase, which is ultimately going to have an inflationary effect on all savings account rates. I mean, you just won't be allowed to be offering a 0.37% rate on a savings account because everyone knows, oh, well, this company, Apple, they offer 4.15%. So it almost feels like what Apple has done will be more consequential to consumer savings rates than anything that Jerome Powell has done in the past 12 months. And it's also interesting that we're even talking about this because it feels like for the past decade or so, while we've been in a zero interest rate environment, no one cared about APYs. Like, who gives a shit about interest rates on savings accounts? Because you weren't really getting any.
Yeah, the difference between
Um,
point 0.2 and point 0.22 didn't really mean much.
exactly. And now everyone's waking up to the fact that, oh, we can get money for our money. And we're seeing all this interest in bonds and in money market funds and in treasuries. And it's starting to feel like the global investment strategy is kind of changing. So my question to you is, has your personal investment strategy changed in the same way that the world seems to be?
It has, but first, it's important, again, just to reinforce how important it is that people are good at money. And people say, well, I don't think about money. Well, you better think about money, because
Mm-hmm.
if you want to be good at it, you want to be economically secure, just the way Roger Federer thinks about tennis a lot, you need to be thinking about money. You need to understand it. You need to understand some of the basics. And we talked about the inflation rate of 10+% here in the UK. If you're one of these people not monitoring your bank account, and if you're not monitoring, I find, your money, it means you're fucking up. It means
Mm-hmm.
the situation is worse than you think. So say they're one of those people that's getting 0.3% on their savings, and inflation is 10%. That means effectively, if you're making £80,000, congratulations, this year you got a 10% pay cut. 10% inflation, 0.3% on your savings, you are now effectively have purchasing power that has declined 9.7%. That's like
Mm-hmm.
your boss calling you in and saying, you no longer make £80,000 a year, you make 72,000. So you need to be all over this stuff and always looking for yield and always looking for the lowest interest rate possible, even if it means taking money off a credit card and putting it onto another credit card because it's offering a lower APY, even
Mm-hmm.
if it means taking a loan against your house to pay off high interest credit cards. You always want to be figuring out ways to reduce the interest you are paying on anything and increase the interest rate that you are getting. As it
Mm-hmm.
relates to my own investment strategy, it has impacted it. And that is, for the first time, I'm actually thinking about investing in credit vehicles, or better known as bonds. I have never. I think I owned one bond once. I think I owned a bond in Gannett, the newspaper company, because I invested with Apollo. It was a good yield. I liked newspapers. It felt like a pretty safe credit. I only owned it for
Mm-hmm.
about a year, but I'm thinking about buying bonds again. I've always owned stocks. And the primary benefit of bonds is, one, they produce cash flow, they have yield, usually, or a coupon payment or interest payment paid to the owner of the bond. And also, they're, generally speaking, a safer bet, because if the company goes out of business, right? So, say Bed Bath and Beyond is kind of careening towards bankruptcy, but there is some value there. The brand, the business, post bankruptcy, whoever owns the company, if it goes into bankruptcy, will get to cherry pick the stores that are profitable. So, say it's worth $500 million. If it has $400 million in debt, the debtors get paid back that $400 million first, and then the equity would split the remaining $100 million. If it gets
Mm-hmm.
sold for $300 million, then the bondholders get that $300 million. They get 60 cents on the dollar, and the equity gets wiped out. The bottom line is, debt holders or the bondholders are at the top of the cap table, or the cap structure, meaning they get their money back first. So it's, generally speaking, a better or an easier way not to lose money.
Mm-hmm.
But the hard part is, over the last 20 years, you haven't gotten really paid for that risk. You haven't gotten paid much. As someone on the flip side of that, as someone who's been on boards, I've always said, what? People are willing to loan us money for 4%? Let's borrow money and buy back stock. I used to
Mm-hmm.
issue venture debt at my companies. I could get venture debt for 3.25%, which is effectively free money. And
Mm-hmm.
you might think, well, you don't need the money. And I'm like, take it. We'll find uses for it, or we'll just have it on the balance sheet.
Mm-hmm.
Now that interest rates have accelerated, you can get decent yield in a vehicle that is traditionally has a little bit less downside, or possible downside is a little bit safer, and you get real yield. So for the first time, I'm looking at buying credit instruments or buying bonds, because I'm also at a stage in my life where I'm not looking to get rich. I'm always looking to get wealthier, but I'm especially looking to not get poor again.
Mm-hmm.
And so a transition from equities to bonds kind of makes sense given where I am in my life and kind of my risk complexion.
What kinds of bonds are you looking at? Is it just corporate bonds or treasuries? What are you looking at?
I would buy a mix. And one of the things, I'd probably go into a bond fund. And one of the things we talk about in the book is the importance of diversity or diversification. And that is, you just never know. So I probably wouldn't buy a single company's bond. I might buy, if the banks that lent money to Twitter offered Twitter bonds, I would buy that debt because I think it'll trade at a huge interest rate. And I think Elon Musk is such a narcissist that he'll never let that company, he'll never let those bonds default because he wouldn't want the loss of face. And I think he's going to make a shit ton of money off of SpaceX. So we'll have the money to pay those interest rates on those bonds. But anyways, what I'll probably do is just invest in a bond fund. And that is I'll pick, some sort of index fund or some sort of mutual fund, low cost, low fees that invest in credit across a certain type of sector or region or certain type of company.
Okay, let's move on to our second story. Social media platform Reddit said it will start charging companies for access to its API. That stands for Application Programming Interface, and it's the method through which other entities can download and process your data. This will have serious implications for AI companies like Google and OpenAI that use Reddit's conversations to train their algorithms. Meanwhile, Reddit is preparing to go public this year. The company makes most of its money through ads, but plans to announce prices for its API access in the coming weeks. So, Scott, this is the latest development in a larger story that's been unfolding, and that is all these generative AI programs like ChatGPT and Stable Diffusion and so on. The reason they're so powerful is because they've been able to collect basically the entire corpus of data on the internet for free, and then they use that data to generate their own content. Now, Reddit is not the first one to do this. Twitter recently started charging for its API as well. But the message that a lot of these tech companies are now sending is essentially, sorry, our content and our data is no longer free. Where do you stand on this issue?
I think it's fascinating. I think generative AI or these large language models have an obligation to figure out some sort of licensing agreement. If they're going to come in and grab the shelves of all of your data and use that to inform the product that ultimately they spit out on the other end based on a query, they technically owe you money. If a radio station plays a bunch of Madonna songs, there is a licensing group that represents most or all artists that they send a check to. If they play a Madonna song 3,000 times, they have a calculation and they send the rights group $3,000 to go to Madonna. The rights group holds on to 10% of it, and they send Madonna or Warner or whoever her label is $2,700. And I think that's what needs to happen here. I was on the board of the New York Times. I don't know if you knew that, Ed. I only mention it about every 48 hours. But I remember saying, and I'm not playing revisionist historian here, when I first went on the board, we need to shut off the crawlers from Google. We need to sit down with the Newhouses at Condé Nast and the Murdochs at News Corp and the folks that own the FT and basically stop all crawling of our data by Google, wrap it all into one big licensing agreement, and then go to Microsoft, who had a viable search engine at the time, Bing, and say, who wants the most precious, valuable, aspirational content for their search engine, and basically get into a bidding war. And the reason that they refused to do it was, A, they all hated each other more than they hated Google because they were stupid. They didn't realize their real enemy was Google, not News Corp or the FT or Pearson or whoever. And also they were worried about antitrust. But the same thing needs to happen here. The content providers need to, whether it's Getty Images or, Musk is saying that they've been crawling his Twitter API. I don't know how true that is.
Yeah.
But if I can go to ChatGPT and I can say, write a blog post about failing young men in the voice of Scott Galloway, and it comes back with a 1,500-word blog post on struggling men with a bunch of dad jokes, and it attempts to be in my voice, it's clear that the large language model has digested, absorbed a bunch of our content.
Yeah.
And if someone is able to monetize that content, specifically the end user and or ChatGPT, and they have crawled my content as a means of informing what they expectorate on the other end, shouldn't we be compensated?
Yeah.
So I think this is going to end up ideally somewhere around where the music industry ended up. And there's also a strategy around here. Adobe has their own generative AI model around imagery. And one of the things they're advertising as a feature is that they own the IP or it's fair use design, meaning that no one will ever get sued here because they own the data or they have rights-free use of it.
Mm-hmm.
So I think this is a big issue. Where it ends up is I do think they end up striking deals with the original creators.
Mm-hmm.
The impact it will have, though, is similar to streaming. It will be sort of a winner take most, and that is the artists that have the most work that's kind of, I don't know, the most iconic that these generative AI models want to absorb and inform their work will make a lot of money,
Yeah.
and there'll be a small amount of money for the long tail. But I think it's coming, and I think it makes sense, and I think they're smart. I think they need to bind together to present one unified front to the AI community.
Yeah. Yeah. The other big story in this AI IP issue was the AI Drake song that came out a few days
Yeah.
ago. And basically, someone used an AI generator to create a song that sounded like Drake featuring The Weeknd, sounded like The Weeknd. It got more than 600,000 streams on Spotify in just a couple days until Universal Music Group got it taken down. And now Universal Music Group is telling all these streaming platforms that you have to block the AI systems from scraping their music. It feels like this could happen in the film industry too. And the rules seem pretty clear in terms of musical artists, because they already have that IP. There's laws around that. That's clearly how they're making their living. But here's a more nuanced example. What about content that users create? So say I create a blog post, or I just message my friends, or I have a conversation on Reddit. And Reddit technically owns the content there because it's part of their API. But ultimately, I was the creator, even though I wasn't necessarily trying to profit from it. And ultimately, these AI models will profit off of the content that I created. So how do you think about it from the perspective of just your average user who's messaging and creating content online? And do you think the rules still apply there?
I get it in theory, but I don't think they're going to be entitled to or get payment, and nor do I think that'll stop them from continuing to post. When you post content
Right.
on Reddit, implicit in that is an exchange of value. You're posting content on Reddit to enter into a dialogue, maybe to get some street cred, to ask a question, to
Mm-hmm.
build awareness of your ability to analyze, the fundamentals of a certain stock, to express your viewpoint, to influence others. So Reddit has figured out technology and made expenditures to create that community and those network effects. And I think
Yep.
they are entitled, in fact, to compensation. I think an individual, now, if an artist is putting out content and they're working hard and they're spending a lot of money, and then that content, as referenced in your example around Drake, is used to create another song that is driven, informed, inspired by a Drake song, I think he and his record label are entitled to compensation.
Mm-hmm.
But when we post blogs, when we post content on different platforms, I think that the value exchange has already happened. And if Reddit can garner additional income, then that will give them the economic motivation and incentive to make the experience better and more rewarding for you. But the idea of trying to compensate, and a lot of people have talked about this, to use the blockchain such that every individual or user of a social media platform gets a portion of the advertising revenues
Yeah.
that they create. I've always thought that's bullshit and a logistical and tracking nightmare. That implicit in your posting content is that there's an exchange there of value that is worth it to you. Drake puts out music because he wants to make money, and he spends a lot of money trying to produce it and distribute it. He doesn't go to MySpace and put up music just hoping to get distribution. There
Mm-hmm.
will probably be forums for new artists who will say, go ahead and use my content, but just credit me or reference me.
Mm-hmm. Yeah. So it sounds like the difference the delineation here is, are you trying to make money or are you not trying to make money? And it seems strange that for so long, all of these companies have had basically free access to their APIs. Their job is to make money. They should be trying to charge as much as they can for access to that. I also wanted to talk about this idea of fair use. So fair use is the term that applies to copyrighted material that's allowed to be replicated, but it's only for things like news reporting, teaching, research. In those instances, you don't need to pay. I assume your position is that fair use cannot be reasonably applied to these AI models.
I don't think so. I mean, unless you want to flip it to, I mean, it'll be up to the creator. If a creator says, so I don't mind that my content is used to inform these generative AI models. I don't mind. I think it's
Yeah,
kind of funny. I want reach. I want influence. That's the
yeah,
exchange for me.
yeah,
But if you're an artist, if you're REM, and this is how you make a living, you might be able to say, no, this is, you need to, this is part of the large, whatever you want to call it, 80s rights licensing model. And if our AI LLM determines that you have used our content to inspire your output, then we have a legal case against you. And I
yeah,
think there's going to be some there's going to be some iconic or landmark or very visible cases here. But I think
totally.
a lot of people, just as they put stuff, when you put stuff up on Discord, I'm sorry, when you put stuff up on Quora or you put stuff up on, shit, what's the one that the
Reddit.
Twitter guy started? Oh,
Oh,
when you post stuff to Medium,
mm,
you can either make it subscription or you can just post it. And I think this is sort of similar. If you just post content, you're looking to build awareness, you're looking to influence people. So if a model comes in and scrapes that, they might owe Medium some money, but they don't owe you some money. You have
yeah.
posted it not with the intention of getting money there. You've posted it for other reasons, for an exchange of value. Now, you might be able to ask for some sort of credit or reference that it says in the references, similar to the way we have footnotes in the book, that says these are the following sources that inspired
Mm,
above a certain amount that inspired some of the content here.
yeah. It sort of reminds me of the economic differences between America and China,
Hmm.
because in China, they have extremely weak intellectual property laws. They have barely any copyright laws. And it basically creates this economy of counterfeit products from, like designer handbags and smartphones and enterprise software. And there's actually a name for this, which is Shanzhai. And it's basically describes this copycat culture economy in China. And it's all by design, right? Because what it's allowed them to do is unleash this power of scale. They can create all these phones, all these algorithms. And it's been a positive for them. But it feels like in America's case, if we don't start cracking down on this stuff and cracking down on these AI models and the content they use, we're basically signing up to becoming a Shanghai nation where your IP is not necessarily protected, everyone can copy each other, and it's kind of a game of who can produce it the fastest and at the greatest scale. So I guess the question that we should be asking ourselves and that I'd ask you is, do we want to become that? Do we want to become a culture of produce, 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 at the expense of originators getting the credit and probably the compensation that they would want? My view is, by the way, no, I don't want that. Selfishly, I would want to get credit for things. But how do you see it?
Well, it's the difference between whether your economy is an artisanal economy or an IP theft economy. And if your economy is growing faster than, say, 8% a year, it means you're in the business of IP theft. And by the way,
Yeah.
America was in that business for the 18th and 19th centuries. We used to go steal manufacturing and textile technology out of Europe. We would actually kidnap artisans and we would basically rip off technology and manufacturing technology and build factories up and down the eastern seaboard. And we basically stole their IP and we printed money. Now
Hmm.
China's doing the same thing to us.
Yep.
Eventually an economy evolves into more of an artisanal economy, and that is they have their own original ideas. So you talk your own book. If
Yep.
you're France and you have luxury brands, you are really into hardcore IP protection.
Yeah.
If you're India or you're Vietnam or you're China, where you can take something and replicate it and produce it at a lower cost, you are very much into the IP theft business.
Hmm.
And both play a role in the economy. But ultimately, companies usually start out as a low cost producer stealing IP, and they're in the business of low cost labor and producing something at scale for a lower cost. And then they move into over time, usually their own original IP, and then they try and protect it. But we
Hmm.
have always been, or not always, but for the last, I'd call it 50, 100 years, been in the business of being artisans and innovation. And we have very, very extensive detailed treaties. We have very extensive detailed treaties with China that says, okay, We know people copy Microsoft Office, but it can't be state supported. It can't be institutional. You have to crack down on it.
Hmm.
And in exchange, we'll continue to buy your goods. But a lot of trade agreements between nations are just about this, the level, how in how disciplined and how many resources, how disciplined in fashion and how many resources are they going to devote to ensuring that the entire nation just doesn't knock off Birkin bags and software and not send any flows, any money back to the United States. I mean, this is a huge issue in the pharmaceutical industry. It's not that hard to reverse engineer a diabetes drug. And these basically pharmaceutical companies will price these drugs at a much lower cost to try and reduce the incentive to reverse engineer and just copy them.
Hmm.
And so what we end up with is a nation that has the highest healthcare costs in the world because we have such strong IP
Right.
protection and such strong regulatory capture by the pharmaceutical industry that basically spends money on these whores called elected representatives that we end up paying the highest cost in the world. Whereas if in India, if GlaxoSmithKline wants to charge above a certain dollar amount for insulin or whatever it is,
Hmm.
the temptation to just rip it off is so great that they keep the prices much lower.
Yep.
So this is a huge cat and mouse dance done by corporations and economies everywhere.
Yeah. Yeah. It feels like the decision that we have to make is, do we care about IP enough to stifle the growth of the AI economy? Because if you do that, then these AI models will have less access to information, less access to data, and they won't be able to grow as fast. Where on that spectrum do you lie? Would you say?
Well, they'll move fast and break things. They won't give a shit. They'll wait till people sue them and let the courts figure it out.
But
They're not going to stop.
if you controlled the universe here, if you could lead the direction of the U.S., are you pro move fast and break things here, or take our time with it?
Well, I'd be married to Emily Ratajkowski, own the Glasgow Rangers, and raise Great Danes. Oh wait, okay, we're talking about IP. That sounds like a pretty good life. I just made that up. Next life, I'd either be a Broadway dancer or a Navy SEAL, and married to Idris Elba. Is that his name? Idris, yeah. Anyways, Idris called me. Uh, Look, I think it's going to be. I think it's important that creators get compensation that inspires them, such that they can make a living and they get compensated. And then if
Hmm.
AI ends up creating, a fraction of the stakeholder value, it probably will. There's no reason they can't pay. Google should be paying creators more.
Hmm.
Google is worth more. Google's worth a couple $1 trillion because imagine if MSNBC didn't have to pay Stephanie Rule or any of its producers or, the gaffer, the sound guy. I mean, the reason why TikTok's such an amazing business is they don't pay their creators anything. So I think that's got to change. I think that
Yeah.
the idea of paying your creators based on the value, the economic value they create for you, or a portion of that just makes sense for me. And again, these aren't new models. The model is what the record of the music industry does. And it
Yeah.
says it's open season. You and I could start a radio station tonight and we could play anything we wanted on the radio station, but we cut a deal with the rights organization of the American music, you know, artists of America, and they track every song and they send us a bill at the end of the year. And I think something similar needs to happen here. We need to learn from the sins of the father, meaning original media, meaning digital media companies, specifically newspapers, that were so enamored with those cool cats from the valley that we let them crawl our data for free and chop it up and sent us pennies in exchange for they got dollars. And we all
Hmm.
thought, oh, but wouldn't it be great to have this traffic and we can advertise against this traffic? We got squat for those shitty digital ads and they built a multi-trillion-dollar business. So they need to learn from the sins of old media companies that were just fascinated by these new content technology companies.
Hmm. Okay, final AI point, tangentially related. So there were these two research papers that came out demonstrating what ChatGPT can do. The first paper was titled, "Can ChatGPT Decipher Fed Speak?" And the answer was a resounding yes. It successfully figured out if central bank statements were hawkish or dovish. The second paper was titled, "Can ChatGPT Forecast Stock Price Movements?" The answer again was yes. The AI evaluated news headlines about public companies and then accurately predicted whether it would move up or down. What do you make of that? Or I'll be more specific. Should Wall Street analysts be worried about their jobs?
I don't know. I think that so first off, the research community has been decimated already. The time to worry about their
Yeah.
jobs was 20 years ago when they separated banking from research. And that is, I forget his name. There was some amazing Solomon analyst who was the best telco analyst. And he used to go into every telco that Solomon Brothers was looking to do their IPO and say, I'll write research on you. Everyone will be aware of you. I'll wink, wink, put a high price target on you if you give us investment banking business. And these research analysts were making 10 and 20 million bucks a year. And then people realized that these guys just turned into whores and weren't giving honest advice. And
Mm.
so they made them separate the banking business from the research business. And because research could no longer win investment banking business for the investment bank, research analysts started making a lot less money. They were less profitable. And slowly but surely, the majority of them got laid off. So the research community has already been decimated. Now, you could argue it created a vacuum in a market for independent analysts like Lynn Alden or some companies like Sanford Research that just do a great job, or is it Sanford Bernstein, doing good independent research. I think there'll always be a market for independent research, even if it's just covering who does the best job of AI or
Right.
who does the best job, what alternative investment funds do the best job of leveraging AI. But there's a reason why Ken Griffin is spending, I think, hundreds of millions of dollars on this. Ultimately, there will be generative AI that looks at what other people are doing and starches out the margin, similar to an arbitrager. But
Right.
I think for the next 2, 3, 5, maybe even 10 years, there's going to be an arms race here. And similar to quant trading, where the initial quant guys found signals and were able to discern signal from noise and make, millions of bets every day on small price movements. And I think it's James Simmons, the guy from Columbia who made billions at Renaissance. He was a math professor
Oh, yeah.
at Columbia.
Yeah.
You're going to see a new breed of hedge fund managers who will make a shit ton of money, who kind of get an edge using generative AI. I think it's a really exciting field. Now, what gets even weirder is your ability to predict their tone and their language and interest rates. I think that is super interesting. But over time, it gets arbitraged out. I think it's healthy. I think it's going to be super exciting. If I were to tell anyone, I was on the phone with this kid from Stern. I spoke at the Stern event, and a kid called me and said he was looking for an edge. He's trying to get in the payments field. I'm like, well, look, it's a tough time to get a job in the growth economy right now because the growth economy is now shrinking. They're
Hmm.
firing people, not hiring them. But the one way to slipstream or short circuit all of this is to become the guy or the recent MBA graduate that really understands how to apply AI tools for customer acquisition or product development in that domain. I
Hmm.
just, if some, I mean, if someone, if someone contacted us at Prop G and said, I know how to use generative AI or LLMs to produce your podcast in different languages or figure out a way to increase the subscribers to your newsletter from 350,000 to 500,000 using AI tools, and this is how you do it, and these are the AI, and these are the models. I'd be like, okay, you're hired. What are you charging us, right? And so that is a
Please don't do
skill.
that if you're out there. Do not contact us.
If you have that skill, oh my gosh, if you're looking for a skill and just start using these things, and you're fascinated by them, and kind of figure out the back end and start figuring out how to piece them together to do kind of sequential requests. Yeah, I think it's a super exciting field. I'm not as worried
Mm.
about it. Everyone else, and you didn't ask me this, thinks it's kind of this doomsday machine. I find everyone who claims it's a doomsday machine and thinks we should pause just wants to catch up and is totally full of shit. See above Elon Musk. But I think it's super exciting. But yeah, it's going to create alpha, or, whatever you want to call it. It's going to create some outsized returns for a hedge fund that figures this shit out.
Thanks, Scott. Let's take a look at the week ahead. We'll see the US GDP for the first quarter, as well as the Personal Consumption Expenditures Index for March. And it's also a big earnings week. We've got Meta, Microsoft, Google, Amazon, UBS, First Republic, Exxon, and Chevron all reporting earnings. Do you have any predictions for us?
Yeah. So Apple in their next earnings report, and I don't know when it is, but if it's in the next couple of weeks, not this one, but the next one where they have some distance from the launch of their banking product, is going to report just monstrous inflows of capital. and the market's going to go crazy. And on that day, Apple stock will go up, and some of the biggest banks in America, their stock will go down because all of a sudden everyone will be like, fuck, here comes Apple.
Do you have any thoughts on how it would affect Goldman Sachs? Because, that it's their partnership, Goldman Sachs operating those savings accounts. It's not entirely clear how they're going to split up that revenue. There's been all this research trying to figure out how it works, but do you have any thoughts on GS?
It'll be good for GS. It won't be as good because at the end of the day, the brand that controls the interface with the consumer wins, because what they could do is just kind of flip it over to JP Morgan, who could also run the back end. So you always want to have the relationship. It's the reason why salespeople make more money than they deserve. If you meet someone that makes $500,000 a year and isn't that smart, but is really fun, they're in sales. And everybody hates them because they make more money and work less hard than anybody else because they own the relationship with the end consumer, the client. And so whatever brand, and in this case it's Apple, owns the relationship with the end consumer, they kind of are at the helm of the bobsled. They're the ones with the power and the leverage here. So yeah, it'll be good for Goldman. It'll be better for Apple.
All right. Thank you, Scott.
Okay, that's all for this episode. Our producers are Claire Miller and Jason Stavers. Benjamin Spencer is our engineer, and Drew Burrows is our technical director. This video was produced by Patrick Warren. Olivia Rainey Hall is our art director. Sarah Shu is our animator. And George Carty is our video editor. Special thanks to Catherine Dillon and Emil Severio. Thank you for watching this edition of Prof G Markets. Please like, subscribe, and tune in next week.